Welcome everyone to our post-budget fixed income outlook for the year 2022. As we all know that the government presented a budget which was very focused on growth, but at the same time the market borrowing program turned out to be a little higher than the market expectation, and that led to some rise in the bond yields. So let us discuss in detail and the implication of the budget on fixed income markets. First of all, the budget is totally focused on growth and growth led by infrastructure. We have seen a number of new projects announced by the government. For example, there is a plan to construct about 25,000 kilometers new roads over the next 3 years, 30 new ports, and then there is a huge expansion plan for the railways. This growth, with the help of the additional capital expenditure in the budget, will then lead to employment generation, and that will address one of the key problems in the economy. This will then lead to the foundation for the longer term growth through the participation of the private sector as and when that is ready after they recover completely from the COVID. So the government is focusing on the infrastructure led growth. Secondly, we are very impressed with the continued improvement in the quality of the fiscal deficit. For example, in the current budget, the primary deficit has come down from 7.7 trillion in FY22 to 7.23 trillion in this budget. Now, reduction in primary deficit basically indicates that the government's focus is on expenditure management, and the current expenditure has come down by that much margin over the previous year in relation to the revenue. And finally, the budget is now laying down very realistic projections. For example, the divestment target has been contained at just about 65,000 crores. Last year, the government projected a large divestment program, but could or is hoping to achieve just about 78,000 crores. Similarly, this year the market borrowing number is relatively higher even compared to the last year, which was a COVID disrupted year. So the projections are realistic, which means that the assessment and the possibility of the achievement of these objectives is far more likely than not likely. So all in all, I would say that a very realistic, focused on growth budget, which would lead to a faster and accelerated growth of the economy and will lead to huge employment generation. So as we discussed in the previous part, that the budget is focused on the growth. Now there is a very impressive set of numbers that we have got for the GST. So for the month of January, the GST collection is at around 1,40,000 crores, which is the highest ever. But then we need to put it in perspective that this kind of significant buoyancy in the GST collection numbers has been witnessed for just about the last 4-5 months. But if you look at the last 3 years, which have been wrecked by the COVID disruption, there is a significant increase in the expenditure of the government. The capital expenditure, which is very important for a sustained development of the economy, has gone up from just about 13.3% in FY19 to 16% of the total expenditure in FY20, and now for the next year, FY23, the contribution or the share of the capital expenditure is 19%, very high. So the expenditure is growing. The second is that the total expenditure of the government has increased by about 8 lakh crores in the last 3 years, whereas the net increase in the GST for the current year after allocation to the states is just about 75,000 crores. And then just to make another example, there is a significant increase in the food subsidy to help the poor during the lockdown time of the COVID. So the food subsidy, which was at about 1 lakh crore in FY20, had gone up to as high as 5 lakh crores in FY21, and for the next year the government is now trying to bring it back to just about 2 lakh crores. We don't know whether that will be enough. So while there is a buoyancy in the GST collection, which by itself is very very positive in terms of how the compliance is improving and how the formalization of the economy is happening. But then there are other bigger objectives which the government is trying to achieve. For example, the huge pipeline of the infrastructure projects, the employment generation schemes, the need to continue to support the poorer section of the economy. And then if you put this big picture together, then one can say that look, this finally the robustness in the GST numbers is showing the impact of the positive work which has been done over the last 3 years. At this point, we are facing two specific headwinds. First, as we all know, that the global atmosphere is turning somewhat unsupportive for the fixed income after a long period of loose monetary policy, and especially in the last 2 years, which were disrupted because of the COVID, which resulted into ultra loose monetary policy by the most of the global central banks. The global markets are moving towards normalization of the monetary policy. The Fed has already indicated for 4 to 5 rate hikes in the current year, and they are also indicating a possible quantitative tightening, which may mean that they may want to reduce the size of the balance sheet. So as it is, we are facing global headwinds insofar as the fixed income is concerned, and expect the rates to move up in the global markets. Now, in case of India, while the budget is very, very positive in terms of the focus on growth and infrastructure development, that requires money. And we discussed about the higher capital expenditure allocation that the government is doing for this purpose. But then the borrowings have increased, and the current year's fiscal deficit is at 6.4%. And even with all the robustness in the revenues, the last year's fiscal deficit could not be contained even at 6.8%, but was finally estimated at 6.9%. What is more important is that even though the fiscal deficit as a percentage of GDP has come down to 6.4%, the actual borrowings are higher than the previous year because the base GDP has gone up, because the nominal GDP has grown at about 11% in the last year and is expected to grow by another 11% in the next year. So the borrowing now is a substantial number, and in the last year, when the global markets were more supportive and the Reserve Bank was also maintaining a very loose monetary policy, they could support the market with the government securities acquisition program, open market operations and operation twists, etc. In the new year, where the global headwinds are already there and the inflation is likely to move up in the second half of the year, it is not likely that the Reserve Bank can intervene with the same aggressiveness as it did in 2021. So markets are a little bit worried about the large supply, and there is another important factor that last year we got about $100 billion plus of increase in the reserves. So that was that additional liquidity which was available in the market. This year we are seeing for the first month, January, there is a little bit of FPI net outflow, and therefore the liquidity conditions also may not remain as benign. Market is worried about all this, and therefore obviously the yields have gone up as an immediate response to the budget announcement of higher borrowing program. So even before the budget, the Reserve Bank was indicating the start of the monetary policy normalization, and as a first step towards that, they have been conducting variable rate reverse repos for the last couple of months, and they have gradually increased the amount from 2 lakh crore in start to about 7.5 lakh crores now. They have also increased the tenor of the repo auctions from 7 days at the beginning to now up to 28 days. This has also come at a time when the global market indications are becoming clearer and clearer that the global markets are also moving on the course of the policy normalization. And as such, the one would expect the Reserve Bank to gradually normalize the monetary policy. However, even though everything looks positive and the growth is improving, the fact is that the output gap is still very high. Even as the COVID started, we were getting into a slowing growth zone where the last reported GDP for the quarter ending March 20 was at just about 4.5%. So there is still a need to continue to support the economy as long as possible. The one thing that goes in favor of India is that for all the negative perceptions, so far the inflation has largely remained within the 4 to 6% tolerance band of the Reserve Bank. For example, for all of 2021, inflation was higher than 6% for a couple of months, primarily led by the highly volatile food and vegetable prices, which then subsequently eased, and therefore inflation fell to as low as about 4.2%. Now it is at 5.5%. So, with the inflation remaining largely within the threshold level of the Reserve Bank's comfort, Reserve Bank has so far maintained a monetary policy stance. In my view, RBI will gradually recalibrate the policy and normalize the policy, but I don't think they want either to rush into any accelerated tightening, or they want any kind of disruption in the market. So my view is for a gradual steepening of the rates over a period of time without any knee-jerk reaction from the market, and we expect the short-term rates to move up now from here as the liquidity normalizes. So to start with, I think there is a clear situation where the interest rates are likely to head up over the next few months till the situation stabilizes. The force of the supplies for the government bonds in India in particular will continue to be there. There could have been some help by inclusion of our bonds into the global indices, but there seems to be some stalemate on the tax treatment of these transactions, and therefore the sense is that it may not happen very immediately. So that is that additional disappointment which the market has to deal with. So when the interest rates are going up, obviously the investors need to be a little bit guarded. There are two sets of possibilities. One, the investors with a long-term investment horizon of 3-year plus. I believe that there is no need for any wholesale change in the approach to fixed income as far as those investors are concerned, and experience suggests that whoever has remained invested for a complete interest rate cycle has got the maximum advantage out of the duration funds. So people who have the long-term investment horizon and who have the patience to deal with the volatility that can come along the way are best advised to remain invested, and if not invested, make some additional investments. However, that most of the time turns out to be more of a theoretical prescription. So from a practical point of view, I would say that investors should stick to the shorter duration funds now. In my personal opinion, although I am a portfolio manager and not a portfolio advisor, but I think at this point in the immediate next couple of months, maybe liquid fund and or the low duration category is a good place to park your money, and then once the markets have repriced some of the immediate concerns fully, and with the onset of the borrowing program, for example, sometimes in the month of April, May, people can look at the short duration fund with a 18-month to 24 months horizon. So I think between these three categories is a good combination for the next 1 to 2 years. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.